Do you ever hear ICT traders talk about narrative, but you have no clue what they're even talking about? In today's video, I'm going to completely break narrative down, dissecting it for someone who has never even traded a single second before, and we'll do it all in around 10 minutes. This is video 1 in a 3-part series where first we're going to check out narrative, then we'll look at structure, and then finally we'll look at how narrative and structure combine to create efficiency. So without further ado, let's just hop straight into it.
So let's learn some narrative, bro.
All right, so we're about to just go through entirely exactly what narrative is from a whole top-down understanding, assuming that you know nothing, right? So the best synonym for narrative is the algorithm's job, right? And to explain the algorithm, because many people don't understand this, right? The algorithm is simply what price has to do mechanically, but given an identity. So price is natural order flow, right? The natural order flow of the big institutions that trade, right? The mechanical behavior, the rebalances, the hunting liquidity. That's what price has to do, right? It's the way that price moves based on these things it has to do. That's the best way to understand it, right? It's like, we think of it like the market's running a program, right? It hunts liquidity, rebalances it to imbalances, to equilibrium, to all these things, right? It pushes price towards areas of resting orders, right? That's what the market has to do. And because of that, we consider that behavior algorithmic, right? So looking back, right, what exactly is the algorithm's job? Simply put, the market's job is to facilitate market liquidity by efficiently pairing those buyers and sellers, right? Think of the market, right? This is a true market that we are trading, right? We trade on the Chicago Mercantile Exchange. We trade futures, right? We trade ES and NQ contracts, futures contracts. We literally trade among buyers and sellers, right? When I want to buy, say I want to buy 3 contracts, at least 3 ES contracts need to be offered up on sale for me to go ahead and buy 3, right? For every buyer, there must be a seller, right? And instead of having a direct search market where I need to go find the seller if I want to buy it, I can literally just go and have the algorithm do it for me. That's what a whole point of having an exchange is, right? That's exactly what the market does for us. And the whole point about this is that price isn't moving just for the sake of moving, right? It's moving to do that job, right? And the algorithm moves price where to the areas where those orders are at, right? So think of the order book, right? When you look at the price chart, understand that orders are placed at every single Y level on the price chart. That's what makes up the order book, right? In terms of limits, there is sell limits above the current price. Every single point above the current price, there is sell limits. Every single point below, there's buy limits, right? That's how price works, right? So think about this. When we place a trade, we place 3 orders. We place our entry, our stop loss, and take profit, right? Say there is a ton of people that want to buy into the market right now, and at the current price, there's not enough sellers. Price needs to move to an area where there's a lot of stop losses, because at that point, there will be a lot of sell orders, right? So price moves, hunts your stop, and then it goes ahead and creates those buying opportunities for the smart money to enter the market. That's exactly what we talk about when we talk about smart money enters the market. Smart money beats dumb money. It's the same simple concept, right? And by doing this, it lets that smart money get into the market, right? So its whole job is to provide entry opportunity and provide liquidity and run this market efficiently. So to sum it all up, right, the algorithm's job and the whole purpose of price movement is simply to seek out liquidity so large participants can manage their positions, right? That's the whole point of the algorithm, right? It has to provide the best possible efficient market movement so that everyone can manage their positions accordingly, right? That's the whole purpose of the algorithm, right? So narrative, right? What exactly is it, and how can we understand it completely when we're actually trading, not just conceptually? Price can do 3 things. Price can either generate, rebalance, or hunt liquidity, right? And this is every single movement in price can be consolidated under one of these 3 categories, right? So in terms of generating liquidity, right, the market can place in equal highs and lows. It can place in stacked highs and lows, and that's what it sets up, equal or stacked highs, so that it can go ahead and run them in a low resistant fashion. That's a low resistant liquidity run, right? That's exactly what that concept is, right? It can place in relative equal highs and lows, all that kind of stuff, right? If the market wants to rebalance, right, where can it rebalance to? It can rebalance to inefficiencies, right? So the market places an inbounce price action that's inefficient. The market has to go and rebalance to that area of imbalance price action, right? That can be imbalance price action, which can be imbalances, inefficiencies, FVGs, fair value gaps. It can be SIBIs, BISIs, whatever you want to call them. The concept is the exact same. It can also go back to range equilibrium or range OTE, right? And that can be either the recent range or the overall range of the current market maker model that we're in. And we'll get into that a little bit later, right? Another point can be consequent encroachment of the wick. So say in the 1-minute chart, we move straight up and straight down. If we zoom out to the hourly chart, if that move is big enough, we might see a big hourly wick, right? Now take equilibrium of that wick, and that midpoint, 0.5, can be consequent encroachment. That's an area which price can potentially rebalance to in whatever circumstance that price is currently in at that moment, right? As well, understand that in rebalancing, price can go ahead and target swings, right? So we can go ahead and target swing points. if it wants to. Say we have a fair value gap that's at equilibrium of the range and we have swing points right here. Price can go ahead and definitely take out those swing points while entering into that fair value gap. That's what price does. And if it wants to do that, that is how price rebounds, right? We can also frame draws and liquidity and trades based off of this on a bigger time frame. We can be trading a rebalance that's also hunting liquidity to one of those lows, stuff like that, right? Now, in terms of hunting liquidity, price can go ahead and hunt everything that it just created while generating and rebouncing, right? So it'd be that the stacked highs and lows, right? The low resistant highs and lows, the clear high resistant highs and lows, news swings, right? So news highs and lows, right? When we have 8:30 news, we usually place in a huge 1 minute candle, right? And dividing that candle gives us a range, right? A high and a low. If we see one side of that candle get swept, we can then look to trade a reversal. Those are areas that price wants to go ahead and hunt, the high and low of that news candle, right? As well, it can be session highs and lows, session swing points, right? As well, previous daily, weekly, and monthly high and low, right? And the main purpose to understand all of this is that price does this in an order, right? It has to generate liquidity and rebalance, doing that at the same time to then go ahead and hunt that liquidity, right? And once price hunts all that liquidity that it just created, there's no longer any more targets for price to go move to, right? So that's why you see price act inefficient and play around while it generates more liquidity and rebalances to an area in which you rebalance to then go ahead and take out that liquidity, right? The main thing to understand is that the best analogy is price is a paint roller, right? If you've ever used a paint roller, you make one track and then you go run over it again. You do 2 coats of paint, right? That's how price works. It sets its own trap and its own food, and then it goes and uses that trap, makes money off of it later. That's exactly what price does. And before we hop into it, there's one more concept that you have to understand before we can put everything together, right? And that is going to be AMD, right? AMD is accumulation, manipulation, and distribution, right? And to put that into a line chart, we can see it right here. What that is a market maker model, right? We see price accumulating on the side where it starts to place in relative equal stacked lows, and then it goes in and places a ton of equal lows, right? This is our accumulation. We go ahead and manipulate at the time when time and price are aligned. We take out highs to the left of us, and then we go ahead and start distributing, right? That's the point where price generates liquidity while rebalancing to some bigger time frame inefficiency or fair value gap or equilibrium of the range, OTE, whatever, right here. Then we manipulate at that point, which we already expect to reject on the bigger time frame, and then we start pushing lower, right? That's how price works. That's the generation, the rebalancing, and then the hunting, right? That's AMD, right? And all this together is exactly what a market maker model captures, right? That's why me and many other people trade market maker models, because this is the fundamental force of the market, and that's literally exactly what a market maker model captures. It captures this generation, the paint roller, and then it captures the run back of all of that, right? That's exactly a market maker model. So with all these things, we can now plug these back into our original equation, right? This is AMD. The market accumulates while generating and rebalancing before manipulating, which starts that distribution phase to go ahead and take all of that accumulation out, and then it goes ahead and restarts. And that's exactly what the market maker model is, right? So let's go ahead and consolidate this just a little bit so we can start viewing it a little bit better. The biggest question that you have at this point is, how do I recognize it, right? How do I know when the market will do A or M or D? How do I know? So the big question is when. And the answer to that question is time and price, right? When time is injected into the market, we see rebalancing end and we see manipulation and distribution start, right? Then when price is alone and time is not in the equation, right? When time and price aren't aligned is when we see simple accumulation and generation, right? We see nothing happen. We just see price play around and set up tracks for itself to go ahead and run later in the day when time and price are aligned. When time and price aligned is usually going to be like New York Open or during news events, CPI. That's why we see such great big moves on CPI, and many other times like maybe end of market macros, exactly when time and price are aligned. So that's how time and price align, and that's how we know when each of these happen. Now, understand that the market is fractal, right? And we just looked at one example of one time frame. This is one time frame right now of what happens, right? So AMD happens on one time frame, but understand that on a bigger time frame, AMD is always occurring, right? And every single AMD has its own AMD. See, think when the market is accumulating, understand the line chart, right? When the market is accumulating, it's accumulating its own price action and distributing, running that internal liquidity that it's generating, right? And doing that in a bigger stage until it gets ready to manipulate, right? And every single manipulation move, the manipulation leg itself, is distribution. After manipulating at that high to go ahead and distribute lower and run that generated liquidity that just created, right? It fakes people out, manipulates their emotions, feelings, does all that. Then we see the start of distribution happen. And during distribution, every single retrace is AMD, right? There's accumulation, and then there's manipulation at the low, maybe into a fair value gap or something like that, and then distribution back higher, right? That's AMD, and every single retrace during that distribution phase is a market maker model, right? And just like it did previously, this happens in an order, right? Price accumulates in the bigger time frame before manipulating and distributing, all doing the same cycle over and over again. That's exactly how price works. That's exactly what a market maker model is, and that's how price is completely fractal, right? So you have to understand that this is just simply one force of the market. There's two major governing forces, right? And this is what moves the market on the weekly and everything below that. But on the bigger time frames is where bigger things come into play. And those things are fundamentals. If we look, fundamentals and this AMD is what actually creates price movement, right? And it's the interplay of those two things that creates every single bit of movement. That's why if you go to the weekly and everything below that, you see market maker models. But if you go out maybe to the monthly or the yearly, you will not see a single model. You'll simply see an uptrend, right? And that's why fundamentals govern those bigger time frames, right? So the realm of the consistent work in the bigger overall time frame direction is the sun. That's the fundamentals. It never stops, and it doesn't happen on a short, scrappy time frame. It doesn't reflect the bigger thing, right? Fundamentals is the bigger thing. However, AMD reflects fundamentals, right? It happens and it's aligned with fundamentals. It's like people working together, right? That's why the biggest thing that goes together between these two is economic news events, right? So if we zoom in, that's where we see FOMC, CPI, Powell, right? All of this stuff happens at moments in which these two are aligned, right? That's when time and price aligns, right? Maybe when there is a big economic event and we need to have the stock market start to recover now because we just ran all of that accumulated liquidity to the downside, all that accumulated sell side liquidity, we just ran that, right? And fundamentals in AMD are now misaligned because fundamentals say everything looks good, we should be higher in stock price, but the AMD cycle just finished. That's when fundamentals now start to play around with AMD and start to take over, right? So it's understanding these two things and how they connect that literally gives you the understanding of narrative and makes every single thing in price completely mechanical. And that's narrative. I mean, that's how the market moves. It's AMD on the smaller time frames that on the bigger time frames is governed by fundamentals, right? And it's the interplay of the two. That's why when we see those news events, those 830 CPI, they take out two sides of the range. Why do you think it did it so perfectly? Because the whole thing is scripted, right? It's under an algorithm. It was going to happen anyways, and it just happened at that exact moment, right? That's how we have to think about this stuff, and that's how it works. These two forces work together. AMD governs the smaller time frames, and it's all fractal. It never stops. Generating, rebalancing, and hunting that liquidity. That's what it has to do. That's what the market has to do, and that's the algorithm and narrative completely explained.
So I hope this video helped explain narrative to you on a simpler wavelength using symbols, visuals, anything like that. If you like the way that I explain things, go ahead and watch a ton of my other videos. I have videos just like this one explaining similar concepts in the market. And understand that this video is part one of a 3-part series where we're going over narrative, structure, and how they both align to equal efficiency, right? Narrative plus structure equals efficiency. That's an equation that occurs within the market every single day, right? And it's something that we need to understand if we are truly serious about becoming great ICT traders. So I hope you guys learned a lot from this video. If you have any comments, anything, just drop them in the comments. I'll be the first to respond, and I'll let you boys go. So peace out.